Hello, greetings, and welcome to Dividend Blasters. This is our 50-second video. Topic today, dividend investors. Invest in United Healthcare. As an investment in a health insurance stock, it is the best. It is going to give you a great return on your investment, price return and total return. I'm going to talk a little bit about that, and I'm also going to talk about what they do, what they deliver, how they compare against their peers, and what you can expect if you apply a disciplined investment strategy in United Healthcare. First, a disclaimer. I'm not your financial advisor. The purpose of this video is for information and education. It reflects my own personal opinions, my research and experience as an investor for more than 30 years. So, do your own research and consult a financial advisor prior to making any financial decisions. And before we start, thank you for joining us here. And I'm going to ask you to give us a like and consider subscribing to our channel here at Dividend Blasters. Share the video with a friend and go ahead and hit that notification bell so you'll know every time we release a new video. So let's step back. Let's ask the question, why invest in an insurance company to begin with? Well, guess what? They are recession resistant. Okay. As you can see, I pulled an excerpt from the Motley Fool. These insurance companies, the successful ones and the ones that can scale up, the ones that are big, have what the Motley Fool calls highly attractive economics. So these insurance companies, to get on their policies, you got to pay premiums. And whether they pay out a claim or not, you got to keep paying. So these companies are cash rich. Okay. It is a recession resistance business. And the more premiums they collect and the less claims they pay out, the better off they are. And as an investor, especially a dividend investor, the better off you are because they need cash to pay out those dividends. These are very profitable companies, and there are a lot of good ones. United Healthcare is really the very biggest one out there. And I'm going to talk about them in a little bit, but let me make you aware of a few metrics that you should be aware of as an investor in an insurance company. And there's three profitability metrics that we look at. One is the loss percentage ratio. It's the ratio of losses to the insurance company due to claims over premiums earned. So you want that ratio. If you're the insurance company, you want that ratio to be small. If you're an investor in that company, you want that ratio to be small. Of course, if you're uh, uh, submitting a claim to the insurance company, you want to get paid. But we're investors here today. Another one is the expense ratio, and it's the ratio of expenses over premiums that the insurance company earns. So basically, it's things like their payroll, their expenses, or operating expenses to run the company over their premiums. You want those to be low as well. And you're going to basically see that these premiums are huge. They're going to be much bigger than the losses that are paid out or the expenses. And then the last ratio is the percent combined ratio. And it's the combination of the loss ratio and the expense ratio. So you add losses and expenses together. And if this company has a ratio less than 100% or less than 1.0, they're profitable. And that's what we want as an investor in an insurance company. We want them to be profitable. We want them to have a low ratio because we want those claims and expenses to be way less than the premiums that are being generated. Because that means those premiums are going to turn into profits. And those profits are going to drive dividends. Next slide. This is just definitional of the explanation of the three metrics I explained. But the major takeaway here is that maximizing premiums earned and minimizing cost claims paid out or the cost paid out. That's what insurance companies want, and that's what we as dividend investors in insurance companies want to see. We want them to be profitable. We want them to be cash rich. Of course, we want them to be fair. If there are legitimate claims out there, we want them to pay them. But as an investor, we want them to have lots of cash and lots of dividends. So let's talk a little bit about United Healthcare. Well, they were founded in 1977. They're based in Minnetonka, Minnesota. Okay, it's a diversified healthcare company. They operate four segments. One that we're most familiar with is United Healthcare. That is really the legacy health insurance company. Then they have Optum Health, Optum Insight, and Optum RX. Let's talk about those four segments in a little bit more detail. United Healthcare, that is the consumer oriented health benefits plan and services. Okay, they offer health plans to employers, public sector, mid-sized employers, private sector, small businesses, and directly to individuals. They also offer coverage to individuals age 50 and over. They offer Medicaid plans. They offer children's health insurance. They also offer health and dental benefits, hospital and clinical services. That's United Healthcare segment in a nutshell. Let's go to the next one. Optum Health segment. This focuses on care delivery, care management, wellness, and consumer engagement. They do a lot of outreach to consumers. They also have a service around health financial services and care delivery systems. They also work directly with public sector entities. That is Optum Health. They have another segment called Optum Insight segment. And in this segment, they offer software and information products. They do consulting to other businesses, and they also offer managed services outsourcing to hospitals, physicians, health plans, governments, and life science companies. So this is really quite interesting because United Healthcare is so big, they deliver a lot of these back office services to themselves. Here they're looking at exploiting that and delivering this as really as an out service to provider to third parties. Very smart business. And the last segment is Optum RX, and this is their pharmacy arm. And basically, they have pharmacy care services where they do retail network contracting, home delivery of pharmaceuticals, specialty and community health pharmacy services, purchasing, and clinical capabilities. All right, so that is the pharmacy arm. Let's press on. So, some summary financials. United Health closed yesterday, April 11th, at $508.01 per share. So it is not a cheap stock. You do have to pay for it. But what you're going to see is that a lot of these big health insurance companies are pricey. And it makes sense to compare them to themselves, like looking at the PE ratio or the dividend yield. So let's take a look. The PE ratio, and we're going to take a closer look at how they compare to the larger market as well, is 20.46. So it's about 20. Earnings per share is $24.82, more than sufficient to cover that forward dollarized dividend rate of $7.52. The dividend yield is kind of modest, but you're going to see that with a lot of these health insurance companies. It's 1.48%. You're also going to see that they have really nice dividend growth rates. We're going to get to that. It's a big company, market cap $470 billion. So remember, we talked about the 20.47 PE ratio. Let's see how they compare to the larger market. They are relatively cheaper than the Dow Jones Industrial Average, which has a PE ratio of almost 26. I'm looking at the very top row, the green number, 25.81. So the larger market is more expensive, relatively speaking, than United Healthcare. That tells me that even though they are going for $508, those earnings are truly spectacular. And those earnings are driven by those premiums that they're collecting on all those insurance plans. Okay, let's take a look at the dividend yield. Well, the dividend yield for the Dow Jones is 2.05. It is better than United Healthcare's 1.48%. I did say they have a modest yield, but hold the Hold your horses because we're going to get to that dividend growth rate, and that's going to make all the difference. And you can also see at the bottom, you can see other indexes as well. So like the S&P 500, the PE ratio is 20.37. It's about the same as United Healthcare, is a tiny bit less. And the dividend yield is 1.54, just a tiny bit more than United Healthcare. So it's really about the same as the S&P 500. Let's press on. Let's look at the price return. Well, the S&P 500 year to date is outperforming United Healthcare. So price return for S&P 500 is about 16 and three quarters percent. United Healthcare minus 2%. So I will say this, that in the last 12 months, a lot of companies in the S&P 500 had a very bad year. Uh, Last 6 months, they're doing much better. We're really experiencing a real bounce in the market. United Healthcare and some of the other health insurance companies, little slower to recover. But as a dividend investor, we're in it for the long haul. And that's what we have to keep in mind. We're looking at a long time horizon. So we're not looking for like a 6 month uh, price return. We're really looking for a total return of at least 10 years or more. That's really the way to look at this, because that's how you grow your portfolio. Look at the long term. So let's take a look at the long term. Okay, well, price return, and this is price return here. United Healthcare is outperforming the S&P 500 about 5 times. S&P 500, 169.6%. United Healthcare for the last 10 years, price return almost 605%. And we're not even talking about dividends yet. Let's look at the max time horizons. This takes us back to 1993 or 30 years. It is killing the S&P 500. S&P 500 is about 880% price return. United Healthcare, 6,600%. It is about 8 times outperforming the S&P 500. Now, as dividend investors, this is what we really get excited about: total return. Let's take a look at the total return. Well, okay, and you know what? The purpose of these next three slides is to show you that it's important to always be dripping, because there is a delta between the price return and the total return. And that delta are your dividends that you're fully reinvesting. So year to date, price return minus 2.46% for United Healthcare. Total return minus 1.71%. So you're still down, but you're mitigating your loss with the reinvestment of your dividends. That's just year to date. Let's press on. 10 years. Now, this is interesting. 10 years, price return 614%. Total return 10 years, 733%. So that's an increase of 119% that is due solely to reinvesting those dividends over the last 10 years. ABD, always be dripping. Now let's look at the max time horizon, 30 years. This is where they truly separate themselves. Price return is really decent for 30 years, 7,100%. Total return, 8,769%. Okay, that's 1,600% about is dividends. That's all it is. Always be dripping. ABD, always be dripping. Now, Seeking Alpha is a wonderful resource that I'm using here, and I am going to leverage their information and their analysis. Looking at the dividend grades, they give United Healthcare A's and A pluses across the board, except for dividend yield, which is a B minus. That 1.47% is probably a little bit lower than other healthcare companies, but it's not bad. It's not bad. Look at that dividend growth, A plus. At 5-year CAGR, 16.74%. That's why they get an A plus for dividend growth. Dividend safety, A plus. You know why they get an A plus? That payout ratio is 29%. That is a very safe dividend. They are going to keep paying it. And they've been paying a consistently growing dividend for 13 consecutive years. They're getting it done. They're halfway to becoming a dividend aristocrat. That's in another 12 years. Dividend yield grades, I mentioned they get a B minus. No surprise there. You can see the breakdown of some of the other metrics. Let's go to the next one, which is dividend growth. They get an A. They get an A, and I mentioned they get an A because of that CAGR. Look at the 5-year CAGR, 16.74%. It's more than 10% more than their sector median. Look at the 10-year CAGR, A plus, 22.23%, more than 15%. It's sector median. Absolutely amazing. That's where they do it. They're doing it in that dividend growth rate. Let's take a look at their peers. Okay, so you can see that United Healthcare, ticker symbol UNH, is the far left. I would say that the closest competitor that they have is Elevance Health, ticker symbol ELV. But by far, the market cap is dwarfed by United Healthcare. It's about 4.7 times more than Elevance. And I tell you what, when I am looking at a company that is going to be growing, paying out a consistently growing dividend, I want a profitable company and I want a big company. Okay. I'm looking at scale because I want a company with the resources that is big, has big market cap, has a lot of profitability to pay a consistently growing dividend. You can see that some of the other competitors are Humana, Centene, Molina, and Health Equity. But I'm going to tell you that my focus is really on United Healthcare and Elevance as their competitor. Now let's look at total return and how they compare. Well, last 1 year, they have been down, okay, 3.33%. Elevance has been up about 0.5%. Humana, about 2.74%. And the others are fairly down. And let's go to the next one. Let's go to 10 years. Now, 10 years, this is something. United Healthcare separates from Elevance, 729% versus 534%. So this is a combination of the growth, which is good. Okay, they're growing, but also that growing CAGR or that growing dividend. Humana's not bad. Centene's not bad. Molina's not bad. The last one's not bad, but it's really United Healthcare. Let's look at Max. Now, this is a sight to behold. 30 years, they have a total return of 8,200%. Elevance, 7,200%. They're both huge, but I'll tell you what, if I have to choose one over the other, I'm going to choose the one that has 1,000% more total return than the one that does not. You can see their trading prices. So United Healthcare is 508, Elevance is 474, Humana is 493. You can look at the others, but I'm really focusing on those two plus Humana a little bit. That's really where I'd say the competition is. And I'll tell you, United Healthcare, in my mind, they're ahead here. Here's a graduated look at total return by different timelines. So you can see from 1 month to 10 years. Uh, you know what? I would say that the 1 month, the 3 month, the 6 month, the 9 month are less important. They're up and down, and even the 1 year. But I start to look at like 3 years and 5 years and then 10 years. And I do like what I see with 5 years and 10 years. And what I see is United Healthcare has a higher total return than everybody else, 110% for 5 years, 10 years, 705%. And we know what it was for 30 years, it was over 8,200%. Dividend summary metrics side by side. I'll tell you, I'm looking at the yield. Okay, so if I'm looking at the forward yield, they're way ahead. Uh, Not a lot ahead. I mean, these are modest yields. So 1.47 for United, Elevance 1.26, Humana 0.72. Um, and then the other three, they don't pay a dividend. So zero for them. Okay, let's take a look at the growth rate. Well, they're all pretty good, but I really, really like the 5-year CAGR for United Healthcare. I also really like the fact that they have been paying consecutive years of growing dividend payments for 13 years. Elevance 11, Humana 6. I got to give it to United Healthcare. And look at the dividend grade side by side that Seeking Alpha gives them. United Healthcare is all green. A plus for safety, A for dividend growth, B minus for yield, A minus for consistency. There's no C's and D's there like Elevance has for dividend yield. They got a C plus, and Humana has a D plus. So other two are not bad, but I'm telling you, when you have a scarce amount of dollar resources to invest, sometimes you can only choose one. And I'm telling you, for me, I'm I'm looking at United Healthcare. Profitability is a really important metric to look at if you're going to invest in an insurance company. You, of course, are going for a company that is cash rich. It's collecting a lot of premiums, generating a lot of profit above and beyond what they're paying out in premiums. And they all have really nice uh, gross profit margins. So United Healthcare is a little under 25%. Elevance is about 26%. But start to take a look at other things like net income margin. They do separate themselves. They're at 6%. Elevance is a little under 4%. Look at the levered free cash flow margin. United Healthcare, a little under 11%. Elevance is less than half, 4.82%. Return on equity, 25% for United, 17.5% for Elevance. Return on total capital, 13% for United, 9.42% for Elevance. Cash from operations. Goodness gracious. Look at this. United Healthcare, 41.37 billion. Wow. Look at Elevance, 11.83 billion. I'll tell you, they're really separating themselves here. Uh, Net income per employee, that's nice to know, but I'm not as impressed. What really stands out for me is cash from operations. Cash from operations and levered free cash flow margin. That's what you want to see. You want to focus on those cash measures. Income statement metrics, I'm going to go with scale. And revenue, they are more than double Elevance, and everyone else is much, much smaller. Net income, 21 billion for United Healthcare. Elevance, 6.4 billion. Everyone is much, much smaller. Let's go to the next one. Balance sheet metrics. Again, I'm going to be looking at cash. Cash is so important. Total cash, United Healthcare 46.28 billion, Elevance 38.28 billion. Hmm. Net debt 23.78 billion for United Healthcare, Elevance 16 billion. So Elevance has less debt, but United Healthcare is so much bigger. I believe they can absorb it just fine. You want to start to look at ratios then to do a comparison. So, for instance, let's take a look at uh, let's look at debt over free cash flow. This is what I like to see. United Healthcare has a debt to free cash flow ratio of 4.97. Okay. Here you want to have a smaller ratio. You want to have less debt relative to your free cash flow. Elevance 8.87. So right here, that metric tells me that United Healthcare has more free cash flow above and beyond their debt levels. Long-term debt over total capital, United Healthcare 37.5%, Elevance 39.76%. Roughly about the same, but United Healthcare comes out on top. Cash flow comparison. Oh, we love cash flow. Look at cash from operations, 41.37%, Elevance 11.83%. We actually touched on this a couple slides ago on balance sheet, but we also break it out again with cash flow, with Seeking Alpha. I think it's really, really important to really look at that cash. Look at the levered free cash flow, 37.8 billion versus 7.99 billion. So levered free means this is your cash flow above and beyond after paying all your obligations. And you want to have the biggest number possible there. Now, what I'm going to do is I'm going to show you a scenario where if you invest in United Healthcare and you do it in a disciplined fashion over a decent time horizon, you will do well. So I'm using the market beat calculator. And what I'm going to do is I'm going to show you here. I've actually already done the calculation of market beat, where you would go ahead and invest starting principal $5,000, and you're going to contribute $6,000 a year or $500 a month, which is about $125 a week. You're going to pay the dividend um, tax rate of 15%, and you're not going to go ahead and take a distribution. You're going to continue to drip, always be dripping, pour it back into your holdings. And I am using an initial annual dividend yield of 1.48%. I got this from Seeking Alpha, and the 5-year CAGR 16.74%. So I'm going to apply that to this model, where we're going to expect a dividend growth rate of about 16.3 three quarters percent each and every year. We're going to apply a standard price appreciation in, um, inflation rate of 3%. That's what we're expecting. The price will go up 3% every year, and we're going to do it for 30 years. Let's see what the impact is. Well, take a look at this. After 30 years, you're going to have an ending balance of $8,254,000. That translates to 4,362% after 30 years. You're going to have an average annual return of 13.5%. So that is your price appreciation plus your dividends being reinvested. You're going to earn $7,447,000 in dividends over 30 years. Your yield on cost. So your yield on cost, or your total dividend payments over your initial investment, is 1,962%. So those are the numbers. You can look at the graph, and what you see here, and looking at the total dollars as well as the yield on cost, is it really goes parabolic around year 26. It's fairly flat for 15, 20 years, starts to go up, and then around year 25, 26, it really starts to take off. So that's why, as a dividend investor, we like that long time horizon. And here's the table that supports the graphs. And you can basically see what your annual dividend is from year 1 to year 30. You can see what your yield on cost is. You can see what your balance is after you're dripping each year. You can actually see what the new balance is at the end of each year. It's the second to last column. And we can also see what the total dividends are tracked at the end of each year that are being reinvested. It's really quite fascinating. And after a while, you can see that your dividends that are being reinvested outpace your annual investment. And at some point, you may say, listen, I don't want to put the $6,000 in this year. I don't need to, because I'm dripping and it is huge. I don't need to do that. The only caveat I would give is if you reduce that, and that's up to you, your total balance will be a little bit less. But you can see that this is a winning investment. Uh, and we're using history as a predictor of the future. Now, does that mean that you're going to get this growth rate each and every year? No, but we have historical figures, and they're the best estimates we can use for predicting. So, folks, that is it. I kindly ask you to give us a like and subscribe to our channel here at Blasters, and consider sharing this video with a friend. And also hit that notification bell so you will know each and every time we release a new video. Until our next video, have a wonderful day. God bless.